Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we are diving into a report from Cloudastructure, a company that offers cloud-based artificial intelligence video surveillance. Will we find a hidden goldmine or just a lot of data? Let's find out. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us. In a nutshell, this document is a resale prospectus, meaning it's about selling shares that already exist, not raising new money directly for the company. It involves a deal where Cloudastructure can sell up to $50 million in stock to a company called Atlas Sciences. We'll break down what that deal means, who Atlas is, and what the potential impact could be. First off, this is a Form SMEsh1 which companies use to register securities with the SEC. In simple terms, they're telling the government, hey, we plan to do this, is it cool? This particular S1 is about something called a registration for resale, which lets current shareholders sell their stock. The main thing here, up to 5 million shares of Class A common stock are potentially being sold by a company called Atlas Sciences. Atlas could be an underwriter, which means they're helping to sell these shares to the public, and that has other legal implications. The shares come from two buckets. Some shares Cloudastructure may choose to sell or put, as they call it, to Atlas in the future, and some that they've already issued to Atlas for making this deal happen. The price that Atlas will pay for these shares can change with the stock's trading price. So if the stock does well, Atlas pays more, and if it doesn't, then less. It's all about timing. Cloudastructure won't get any of the money from the sale of these shares, not directly. But they could get about $50 million if they decide to sell more of their Class A common stock to Atlas, assuming the deal is fulfilled. Sales may happen over time after the SEC says this prospectus is effective and after other deal conditions are met. In terms of who exactly wants to sell and how may it be done in practice, Atlas will be selling the Class A stock that counts as an underwriter here. For context, think of an underwriter as someone who helps a company issue securities to the public. Cloudastructure trades on the Nasdaq Capital Market under the ticker symbol CSAI. Back in July of 2025, the stock traded at about $2 per share. Let's talk about the Atlas deal. It's all in a purchase agreement where Cloudastructure can choose to sell up to $50 million in Class A common stock to Atlas over a 24-month period called the commitment period. Atlas gets something in return. They've received shares called commitment shares just for promising to buy shares if Cloudastructure wants to sell. So how does Cloudastructure actually sell its shares to Atlas? Simple, by sending Atlas a put notice saying I want to sell X shares to you. Of course, there are rules on how much can be sold and when. Cloudastructure will need to honor a minimum amount when they put up a number of shares to Atlas for trading. That amount would be no less than $25,000, and the maximum amount they can put would be either $250 price Atlas pays, depends on a calculation involving the lowest trading prices over a certain period and has some deductions for costs on the Atlas end. Now, before Cloudastructure can actually sell these shares, a few things need to happen for all parties involved. The SEC needs to approve everything, meaning this whole process has to be legally sound. The company representations need to be up to date. No new laws can block things. The stock needs to be trading, and Cloudastructure needs to have the shares available. These are standard protections to make sure the deal is above board. Let's discuss those commitment shares Atlas received. They are in effect compensation for Atlas agreeing to potentially purchase Cloudastructure's stock when asked. Cloudastructure calculated those initial shares based on share price. Because the market price of Class A common stock declined, Cloudastructure actually had to provide additional commitment shares after the closing of the purchase agreement. Importantly, Cloudastructure can stop the deal at any time, except during specific valuation periods. It's all about flexibility. Even if the whole agreement ends, and it automatically will after 24 months, Atlas still gets to keep all those commitment shares. The only exception to this is if Atlas violates certain contractual obligations. How does selling potentially millions of shares affect people already invested? Dilution. Issuing new shares means each existing share represents a smaller slice of the company. However, the total amount of shares owned by existing stockholders does not decrease. They may or may not decide to sell the entire amount of shares. The market conditions will need to be favorable. If Cloudastructure sells shares to Atlas, they'll use the money for general corporate purposes. This is a fancy way of saying things will be sustained and possibly new ventures can be created down the line. Time to talk about Atlas proper, the selling stockholder. It's all the selling stockholders' Atlas decision on when to sell the shares. As of July of 2025, they owned 373,144 shares, or a little under 3% of Class A stock. The filing is registering about 5 million shares that might be sold in total. In terms of how Cloudastructure is structured, they can issue almost 500 million total shares, but they're divided into different classes. Class A common stockholders have a vote in electing directors. Then there are Class B shares, a slightly differently named stock with 20 votes per share. At any point, one Class B share can be converted in a Class A share. They also can issue up to $150 million in preferred stock, which gets certain advantages, including potentially getting paid first. On that point, there are Series 1 and Series 2 preferred stocks. The specifics are quite complex. These preferred stocks accrue a preferred return and have what's called liquidation preference, in case the business ceases to exist. More precisely, the Series 1 can issue up to 30,000 shares with a value of about $1,100 per share. Their ranking is also extremely important. Essentially, they have equal ranking relative to other stocks, including in the event of liquidation. The Series 1 preferred accrues a 10% per annum return of the $1,100 share paid quarterly in cash. If certain obligations are not met, it will actually increase to 15%. These shares can be converted with different price points on doing so. All these specific preferred stocks allow for voting rights. Series 2 works pretty much the same as Series 1. In total, there are about 40,000 shares authorized. The Series 2 stocks feature a 9.5% rate of return on the dollar amount that would be expected quarterly. This increases to 15% if things fall through on either side. The Series 2 preferred shares also allow for voting rights as usual. Cloudastructure has to abide by a good amount of covenants. For context, these are restrictions preventing the company from taking certain actions, and they're standard for these agreements. Lastly, court disputes need to be handled in Delaware. Finally, Atlas will probably sell these shares through brokers already doing this type of work on the market. So while they could negotiate privately, it's expected that the broker will sell for them according to market standards. Cloudastructure is handling expenses and indemnifications. Basically, Cloudastructure is paying for this. Honestly, this is a fairly standard agreement. Cloudastructure is securing a potential funding source, but they're giving up some control and diluting their stock in the process. Whether it's a good deal depends on their growth plans and how well they can execute. A weakness might be how reliant they are on the PropTech market by having deals for multiple property management companies. For Cloudastructure, a key risk is probably how well the equity actually works out for them. Are the preferred stocks that are being offered potentially too high relative to a more market favorable agreement? In conclusion, proceed, but also proceed with caution as always. Alright, that's our breakdown of Cloudastructure's latest prospectus. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.